This is a video about the impact of COVID-19 on international bond markets. This is a second video on the impact of COVID-19 on bonds, but this is specific to international bonds. Now, in the previous video, we talked about the specifics of a bond versus a stock. With a stock, you become partner to a company, and therefore you're taking operational risk. And there's always that expectation component to the price. And therefore, the price can go up and down based on people's expectations. Sometimes you don't even need an actual fact to alter that price. With respect to bonds, your main risk is always the default risk. I mean, there are other risks, obviously, but your main risk is the default risk. So the likelihood of you getting your money back is the main concern. During the times of COVID-19, when the epidemic started, U.S. financial markets have collapsed along with the world financial markets, and we have seen a stock market drop as low as 40%. But we haven't seen this in the U.S. Treasury bond market. In fact, in the previous video, we showed that some of the U.S. Treasury ETFs portfolios have gone up in value. Now, in the international bond market, these are still fairly less risky compared to the stocks, even the US stocks. And on the screen, you actually see now two ETFs, a BND and BNDX. BND is an ETF, a portfolio of the total bond market in the US. And it's US government heavy. But it also has a little bit higher risk issuers, a little bit. Now, the BNDX is the international version of the BND. So the comparison now is the green and red candle chart, which is the BND, and to the blue, which is the BNDX. Now notice this chart is based on return, which means, and it is year to date, which means if you were to buy into this BND ETF as of January the 1st, you would have realized right now about 6.7% profit. If you were to buy into the BNDX as of January the 1st, you would have had about a 3% profit. Now, notice how at the beginning of the year, these two go almost hand in hand. But then US bond market seems to outperform the international market, international bonds, and coronavirus seems to have a serious impact on both. And they seem to actually drop as high as 5%. Now, notice, though, that the U.S. market have recovered a little bit better. And the international markets are still, they're recovering, but not as well as the U.S. bond markets. In the past, we have seen a similar trend, especially after the financial crisis in 2007, where a lot of the international investors considered U.S. to be a safe haven, and therefore preferred U.S. bonds to a little bit higher risk international bonds. But when we say international bonds, it actually includes European countries, countries like Japan, whose economies are actually quite strong. However, it also includes countries that are classified as emerging markets, and although to a significantly lower level, low degree. And therefore, there is the concern that some of these markets may not recover as well as we hope them to recover. Now, similar to previous videos, I did a little bit of a comparison of different types of international bonds. This is the BNDX that we talked about, and notice how, the lowest that we have seen is 54.77, and the high that we have seen is 58.27, and the average price is 57.11. So the range is about $3.50, and from the average price, the lowest that we have seen is about 4% lower. So your risk for the past 7 months from the average price was a drop of a 4%. Now, if you look at the emerging markets, now these are the ones that usually pay a little bit higher return. Now, because they are considered to be a little bit higher. So because of this added risk and the expectation of a higher return, people who are, who have a higher risk appetite might prefer these. But on top of that, if you wanted to take the local currency risk, then the local debt funds, such as ELD, caters to this appetite. And notice, however, that these four have really suffered significant risks within the past 7 months. Notice we have seen prices to drop as high as 20% from their average price. And although they may have recovered, this is the potential that they could actually go down to. Therefore, that's a definite risk. And notice how all these four, perhaps ELD fared a little bit better, but HYEM, and this is the equivalent of in the previous video, how we looked at I think we looked at junk bonds, JNK. This would actually probably correspond to that a little bit closer, as this is also a high yield bond. So whenever you hear the term high yield bond, that usually translates into a high risk bond. And the high yield is a wishful thinking, hopefully high yield. So notice that there's always a risk and then the corresponding return, but expected corresponding return, not a definite one. So high risk simply means that you could actually lose all of it, all your money, but you're hoping for a higher return. So in this case, the HYEM has dropped quarter of its price from the average price. So notice the average price is 21.69. The current price is 22.97. It actually fell down to $16.30. And I'm guessing for those who hold this, who own this, that was quite a bad day. I mean, you're thinking you own bonds. What could go wrong, right? Well, that could go wrong. So then emerging market government bonds, these are similar to our US Treasury bonds, while other governments issue their own Treasury bonds. But from our perspective, we refer to them as government bonds, sovereign bonds. And sovereign nations issue their own government bonds. And notice how even those actually suffered quite a blow. And from the average price for the past 7 months, these have suffered a loss or a drop of about 19.5%. And that's quite a bit. So compare these now to the U.S. bond yields and the risks that we have gone through during the coronavirus. We seem to be a little bit more risky on the international bond side. Now, if you look at the international corporate bonds, they seem to be very similar compared to the government bonds. There's another one right here that's also international treasury bond, but not specific to the emerging markets. This seems to be a little bit better. Actually, this seems to be better. And notice this is international treasury bond that includes, possibly let's check out who they include. So IGO and VWOB, I want to compare very briefly. So IGO, let's see what they include in the IGO. Went to Yahoo Finance, and I pulled up the ETF. And then if you look at the holdings, we'll see that, yeah, so this includes countries like European countries, and countries like Singapore, which we consider them to be stronger economies, and therefore you actually see a risk relatively safer compared to others. But if you look at the VWOB, we'll see more. Well, this is specifically emerging markets, and therefore a higher risk. And you'll see countries, Qatar, Saudi Arabia, Russia, and so on and so forth. So even though these are still oil producing countries, their economies were especially vulnerable because of the price of oil plunged during the epidemic. So the international bonds have, if you're looking at developed markets such as Europe, Japan, and Australia, Canada, and so on and so forth, you actually have a relatively lower risk. But then if you're looking at emerging markets, smaller economies, growing economies, then you're looking at a substantially higher risk, and almost at the level of US corporate risk when we looked at the US corporate ETFs. So this is the impact of coronavirus, or the COVID-19, on the international bonds compared to the US bonds. So if you have any questions, please do let me know. And thank you for watching.